I really do think we're near the end game, as Rafi Farber puts it. I really don't think there is a whole lot more that can be done, but I've been wrong up until this point. And I want to make that clear for the record. Wrong as far as the quote-unquote collapse, but not wrong as far as preserving your wealth by holding precious metals. So I think the deficit matters more now because of the silver awareness and the amount of people participating in the silver market. And I think the shift for vaulting and futures markets and exchanges and industrial uses through the East are very big and somewhat subtle at this time components to the bigger picture of silver. So I'm still bullish on both the metals, and I still think silver will outperform on a percentage basis when it's all said and done.
The global economy stands at a critical juncture as traditional financial systems face increasing pressure and investors seek reliable wealth protection. Navigating these volatile markets requires a comprehensive understanding of physical commodity cycles and changing global demand. David Morgan, a prominent precious metals authority and publisher of the Morgan Report, emphasizes that long-term supply deficits are rapidly reshaping the metals market landscape. He predicts that silver will ultimately outperform gold on a percentage basis before this cycle reaches its end. According to these forecasts, silver anywhere under $60 and gold below $4,000 represent exceptional strategic gifts for long-term investors. While brief seasonal pullbacks might surface in August, massive paper order density around $50 establishes an extraordinary support floor, making a slide to $40 extremely unlikely without a severe worldwide collapse. Sustained industrial consumption will continue driving upward momentum across global markets. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
I think there's two major things to look at. One is the continual deficit in the silver market. I think we've already addressed gold. I mean, gold is just establishment is being bought hand over fist by central banks and others. On the silver side, we see as I said, the industry, but you also see that the shift has gone to the east. In other words, you're seeing these new vaults that are being built in Hong Kong, Shanghai, and Asia is taking a much more of an interest in the silver market of late. In other words, the last several years. It hasn't been in the last couple of weeks, but it's been more and more notable, more and more profound, and more realized. On the deficit side, coming back to that, we had a deficit for 15 years straight from 1990 to 2005 inclusive. And no one ever talks about that unless it's me. But that deficit really didn't have much impact on price whatsoever. However, this time I think is different because there's so many more silver investors worldwide, or silver hedgers, or silver buyers, or silver speculators, or silver stackers. I don't really care what term you use. But there's more interest in silver now than ever before in modern times. So the deficit does matter. It mattered in the past, but this time has more. But we're really at about the same level we were in 1990 with about 2 billion or more ounces of above ground silver. The difference between 1990 and now is that a lot of the above ground silver is already bought and paid for, meaning it's sitting in an ETF, an ETP. It's maybe on the COMEX, but in the eligible categories for long-term investors that don't really want to sell it. So it really comes down to the float. How much freely available silver is there? And the answer is not a lot. Now, there has been more since the move from $50 and above, because a lot of retail decided it's never going to hit 50 again, and it did. Decided that's good enough for me, I'm out, I bought too much, or I'm going to make a profit, or whatever their reasoning is, they sold. And 60, 70, 80, 90, 100, a lot of people sold. So that silver is yet to be turned in, some of it, but most of it's still sitting there waiting to be re-refined in 2,000-ounce commercial bars. That's what usually happens. Not all of it. Some of it goes from, Silver Eagle back out into the retail market. In fact, it'd be stupid to melt down the Silver Eagle, but some have been. And so that's where we lay on that. So I think the deficit matters more now because of the silver awareness and the amount of people participating in the silver market. And I think the shift for vaulting and futures markets and exchanges and industrial uses through the East are very big and somewhat subtle at this time components to the bigger picture of silver. So I'm still bullish on both the metals, and I still think silver will outperform on a percentage basis when it's all said and done. Another breakout confirmed, and gold has the luxury that silver doesn't have, and the luxury that gold has is that it's backed by the central banks, and the banks continue to buy gold even as it continues to rise in price. And silver doesn't have that monetary component based on the banking system. It certainly does, have a monetary component for the retail investor and, some hedge funds perhaps and some ETFs. So it's not left out in the dark completely, but it doesn't have that steady eddy monetary aspect by the establishment that gold has. But it also has an advantage over gold, and that is 60% is being used by industry. The trend continues higher and higher year over year on the long term. I mean, there's some years it's off by 1% or something like that, but from the last 25 years, it's gone from 35% industrial usage to 60%. That's the big trend. So that means that it's almost like a stock buyback program. Every year, the billion ounces of silver, that's 850 for mining and 150 for recycling, that billion-ounce silver supply gets eaten up, 60% of it, just by, let's say, modern technology on a global basis. So that's an advantage that gold doesn't have. It's got steady buying from the banks, but silver has steady buying from industry. I think it's still possible that we might get a real quick down flushing one more time, and that would be typical of August behavior. We usually see the lows in August for the metals, but not always. But based on my own, rule, the Morgan rule, we do a horizontal line, and it's got to get above that line 3 days in a row, and it has to be on above average volume, and that has taken place. So based on my own, abilities, forecasting, I'd say, yeah, we have broken out. Above and beyond that, I think anything under 60 was, a gift in the silver market, and below 4,000, probably a gift in the gold market. Long term, if we do get some spike lows in the future, I think it's very unlikely to hit 40. I mean, you can't rule anything out on silver. You could say or gold, but primarily silver. I believe that there are tons of paper orders in the $50 range, maybe slightly below. I think any industrial user that has a department to buy silver for their purposes would load up at that $50 level, which means there'd be so much resistance and so much buying pressure in that region that it'd be really difficult to see hit 40. Again, you can't rule anything out. I mean, if we're going to a super worldwide depression and copper takes over the solar industry and AI centers don't come to fruition, I mean, it'd have to be pretty extreme to see a $40 price move, in my opinion.
Understanding the distinct dynamics of gold and silver is crucial for evaluating precious metals performance. Gold benefits from consistent central bank buying, providing a steady institutional backstop even as prices reach record highs. In contrast, silver derives its primary strength from expanding industrial applications, which have grown from 35% to 60% of total annual supply over the past quarter century. This ongoing industrial consumption acts much like an annual corporate stock buyback program, constantly reducing total available supply float. Simultaneously, physical vaulting and trading activity are shifting noticeably toward eastern hubs like Shanghai and Hong Kong, signaling a broader geopolitical realignment in physical metal distribution. Persistent structural deficits built over decades highlight an increasingly tight physical supply, as major portions of above-ground metal remain locked in long-term exchange-traded funds and institutional holdings rather than circulating freely. Now, let's get back to the interview.
There's been indications, and actually the direct words, the direct quote, COMEX is being drained. That's an exact quote. And, it's put out kind of as a challenge as being one of the most important factors surrounding the silver market. And if you're not looking at that, then you're not doing your job, so to speak. And that's how I caught it. That's my perception of what was stated. What's so interesting about that is that the COMEX is not being drained. Over the last 20 years, the COMEX inventory has increased substantially. And then you, of course, have to do the nuances. The nuances are that the eligible category has increased dramatically over the last 20 years. But the register categories, which is the small amount that the dealers have to work with, ebbs and flows. I mean, I've seen them as low as like 30 million ounces, which is pretty small relative to the global silver supply of, as I said, 1 billion ounces. And I've seen it drop into that level a few times and kind of, giving it this kind of thing like, oh boy, we're close. So I wonder what these dealers are going to do. And you'll find out, or at least every time so far, what we found out is somehow, some way, more silver comes into the COMEX in the registered category and, moves up to 90 million ounces from the 30-ish million ounces. So the fact is COMEX is not being drained. Now, you could look at the LBMA, and it's certainly a lot of that gold in the LBMA is come off. I did that update. I'm confusing myself a little bit over the weekend. I did an update on gold supply in the LBMA. Silver has been, I'd argue the silver supply has been pretty much drained. Doesn't mean there's 1 ounce left in the silver supply at the LBMA, but the float, the amount that's not dedicated or covering the ETFs and the ETPs, is rather substantially less than it was, let's say, a decade ago. But I think the most important thing is what happens on these deliveries, because a lot of them are notice to deliver, which is not quite a delivery, although once it's on notice, you're pretty much required to put up the warrant. In other words, the certificate of authenticity / ownership to the party that you are required to produce the physical silver to. But this goes between banks all the time. In other words, it's sort of like playing in a closed-end fund. I mean, it's between parties that are part of the overall big boys in the game. And this, I think, is understood by some and not by others. In fact, I'm going to be interviewing Bob Gottlieb, who was a trader for years, about some of the nuances of how banks really operate. One misnomer you didn't ask, but that said, these banks, once silver goes beyond this point, the banks are billions, they're going to lose billions. Banks take very little risk. The open interest that's shown on the COMEX is usually covered on the over-the-counter market, the LBMA. And this is something that's, to me, almost common sense, because it's the same group. Primarily, not every single bank at the LBMA has a position at the COMEX, but the lion's share do. And this means that they are able to offset their risk in a different location. And this isn't considered very often by much of the silver community. So, number one, it's not being drained, not yet. And that's a good thing to look at. I'm not disputing that, that's probably the last place to get silver. You really want to do it. Let me put my tinfoil hat on for a moment. Most of the silver that's delivered doesn't go through the COMEX. It goes directly from a refiner to the end user. It's cheaper. It's more efficient. You don't have to pay a storage or delivery fees or insurance or all that stuff that you have to do through the COMEX. You might have to pay insurance. I'll take that part back. Regardless, it's more efficient to go to the refiner. And if you are taking it off the COMEX, it's usually, not always, because you can't find it anywhere else, or it's easy to get to because there's commitments for, let's say, commercial bar silver for other obligations. So if it were to occur where the registered category got down, let's say below 30 million ounces, I've never seen that I've been watching it for, decades. Not saying it hasn't, not saying I haven't missed it, but to my best recollection, it's never been that low. And it goes to 20, and it goes to 10, and it goes to 8 or whatever. That would be a signal that something is really going on, but doesn't necessarily mean, can reload. So I don't want to belabor it too much. I think it's important to watch the absolute offtake. It comes off of the shelves and outside the COMEX, which actually leaves the COMEX vaults. I think that's critical. As far as swapping metal between banks, it occurs all the time. It's kind of the game they play, maybe for leasing. Primarily, it's for leasing. I mean, if you read Bob Gottlieb's book, there's a lot that goes on with these small spreads that are leveraged and on and on. I'm not going to go into it now. I'm probably going to interview him at some point. But there's a lot behind the scenes that just isn't, it's nuanced and not really understood by much of the silver community. I'm not trying to, sound like I'm part of the establishment. Certainly anyone that knows me knows I am not, but it's important to speak the facts and for people to have a better understanding, because if you misunderstand the situation and you truly think the COMEX is being drained, you might make an investment decision based on that mis or disinformation that you might not have made if you had the facts.
Popular narratives suggesting an imminent drainage of COMEX physical vaults often overlook crucial institutional mechanics. While registered inventory fluctuates between 30 and 90 million ounces to cover immediate dealer needs, total COMEX silver holdings have actually increased over the long term through growth in the eligible category. The true structural tightness is concentrated within the London Bullion Market Association, where available float has diminished significantly to back various financial products. Furthermore, the majority of industrial physical silver bypasses commodity exchanges entirely. Commercial end users source directly from refiners to eliminate unnecessary storage fees, transit costs, and exchange delivery overhead. Major bullion banks also operate with minimal directional risk, routinely offsetting futures positions through over-the-counter transactions and complex spread leasing agreements. Distinguishing between speculative paper claims and genuine physical refinery offtake is essential for accurate market evaluation. Monitoring actual vault withdrawals outside the exchange system provides a far clearer picture of supply availability than routine inventory shifts between institutional players. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.